Harvard economic and financial historian Niall Ferguson joins us once again. Dr. Ferguson, thanks for staying with us here. So I was talking to my colleague as well, Tom Keene, earlier this hour, last hour, and he said to keep a close eye on the Europe region, that he's hearing perhaps talk of a downgrade. We're watching the euro in particular get hammered today. It's back above $1.36, but it breached that 1.36 level earlier. What are you hearing?
Well, this is a crisis that has been on the horizon for quite a while. If you're a nerdy bond market historian like me, you could see this coming a mile off, because not only Greece, but really a significant number of Eurozone members have been plunging into the red with their fiscal policies in the wake of the financial crisis. And suddenly the markets woke up and realized that these were not credible fiscal policies, that a 13% of gross domestic product deficit for Greece was something that really required higher yields to compensate investors for risk. I completely agree with the analysis you just presented. The contagion is going to spread. It already is spreading to Portugal. It is already spreading to Spain, not to mention Ireland. And frankly, when you look at the debt numbers, there's no particular reason why Belgium and Italy should be entirely free from worry. So this is something that really had at its root the massive fiscal response of European governments to the crisis. And I think Tim Bond's point that this could spread beyond Europe is really worth dwelling on. I looked at the IMF numbers for gross debt to GDP today for developed economies. The United States is number 6. It is not that far behind Greece in terms of the size of its debt and the problem it's going to have getting back into any kind of balance in the foreseeable future.
All right, since you're a self-described bond nerd, Dr. Ferguson, how do you contain these ripple effects?
Well, it's extremely difficult, because the way that the Eurozone was designed, there is no bailout on offer for a country within the Eurozone that gets into this kind of fiscal trouble. The ECB is not mandated to lend money in that way, to print money to help out a heavily indebted member state. Remember, when they set up the Stability and Growth Pact 10 years ago to try and contain fiscal deficits, the maximum was supposed to be 3% of gross domestic product, not 13%. And now Greece is being asked to reduce its deficit in the space of 2 or 3 years from 13% to 3%, which is the biggest fiscal squeeze it's possible to imagine. Now, that is not going to go down well with, for example, the large public sector workforce in Greece, and indeed in these other so-called PIGS economies, Portugal, Ireland, Greece and Spain. It's a rather unfortunate acronym here, but you know where PIGS live? Well, these countries are pretty much in that situation as the squeeze mounts. The more they tighten their fiscal policy, the worse their economies are going to do, the more unemployment there will be, and I would imagine there will be general strikes in Athens and in other countries pretty soon.
Abu Dhabi bailed out Dubai, right? Could that happen? Is there any other massive funding anywhere that could help, again, contain this?
Well, I'm not aware of any massive oil producers inside the Eurozone that can easily write a check. The expectation at Davos last week was, of course, that the Germans would come through, because the Germans nearly always write checks for peripheral countries in the European Union. But this is getting harder and harder to sell to a German electorate. After all, the Germans had some of the toughest times last year. Their GDP contraction was somewhere in the region of 5%. And it's going to be tough for Chancellor Angela Merkel to sell to German voters the idea of a check, not only to bail out the Greeks, but also conceivably to bail out these other so-called PIGS. I think it's going to be messy because there is no mechanism. And that is the big problem. There's no way of doing this. And as long as there's no mechanism, you can be pretty sure there's going to be a protracted political wrangle.
Does the euro, the currency itself, survive?
Well, of course, there's always been a question mark. 10 years ago, my friend Larry Kotlikoff at Boston University and I said that this kind of fiscal shock would put a real strain on the single currency. Now it's happened. I think the Germans, and probably the French too, will do whatever it takes to prevent a breakup of the Eurozone. And it's not particularly in the interest of the Greeks to go back to the drachma, because I don't think markets would be very impressed by that. So I think in the end, the Germans and the French will probably bail Greece out by some kind of bilateral transaction. The question really will be whether there is then an orderly line of other southern European countries saying, me next. And that's going to be ugly if it happens.